Welcome to the Insightful Investor Podcast, a weekly series that seeks to share industry, investment, and market insights. Learn more about our show at insightfulinvestor.org. My guest today is Josh Jones of Boston Partners, a firm with $125 billion in assets as of 9/30/25 and a 30-year track record of disciplined bottom-up value investing. All the things we're going to talk about today. Josh oversees international and global long-short portfolios and brings a uniquely data-driven, fundamentally grounded perspective. I'm thrilled to have him here to share his insights. Welcome, Josh.
Thanks, Alex. I'm excited to be here to speak with you today.
Let's go back to kind of the early years. When did you first realize you love picking stocks, and what moments that you can recall pushed you from a consulting mindset to a hands-on investing career?
Yeah, so I guess there were kind of nuggets of it. I mean, I dating myself here, but I graduated from high school in 2000. So that was, around the peak of the tech bubble. I remember kind of following the stock market and just being excited about it. But I obviously had no idea what I was doing back then. And then I actually interned with Boston Partners between my second and third year at university. I went to Bowdoin College in Maine, so a liberal arts background with a focus or major on economics. I knew I enjoyed economics, but I didn't have kind of a traditional accounting finance background, just with, the liberal arts focus. But I really enjoyed my time at Boston Partners. And I kind of at that point, just the combination of economics, human behavior, started to, trade my own little portfolio, follow the stock market. But when I graduated from Bowdoin in 2004, I, still didn't really know exactly what I wanted to do. And so I thought maybe eventually I'd want to go to business school. And I actually joined Cambridge Associates, which is a financial consulting firm. And it was a great place to kind of, I got a lot of exposure to a lot of smart people. And in that role, it was, more asset allocation. So it was meeting with a lot of different managers, a lens into private equity, debt, public markets. I pretty quickly realized that my passion was still the public markets over, the private markets. And at that point, it was, so we're a year and a half into that. In 2006, an opportunity came up to rejoin Boston Partners basically as a junior analyst. And so I took that. That was January 2006. So I'm 20 years into my Boston Partners career. And that was really kind of the genesis of it.
How would you describe your investment philosophy, and what common component of that would you exclude that many investors you feel wrongly include?
At Boston Partners, we're fundamental value investors. I like to think about it as, ultimately, if you think about investing, there's a spectrum of what people are trying to do. Everyone's ultimately trying to make money, outperform the stock market. There's just different ways you can take advantage of effectively dislocations. And at Boston Partners, we're big believers that your starting point should be value, that ultimately you should pay the right price for businesses. But inherently, and we're very data driven in that process, we focus on trying to incorporate quality and momentum into the process. And it's really a discipline for avoiding value traps, which are kind of the notorious risk for value investors. So we take a very probabilistic approach to the market in the sense that we're very data driven, which I think has some big advantages. And happy to talk more about that. But ultimately, it's trying to focus on the data, deciphering where those opportunities are in the market in terms of kind of the best combination of value, quality, and business momentum, and incorporating that into our portfolio. In the context of kind of de-emphasizing what some investors overemphasize, everyone loves a good catalyst, but I kind of think it's a little bit of an overused term in our business, particularly with a lot of the very leveraged short-term money in the market. Everyone's kind of talking to the management teams, figuring out what the next quarter is going to be like. And ultimately, increasingly, we're paid for duration, which is how efficient markets are. So we think about momentum really as business momentum. But, again, you'll come across catalysts here and there. But I think sometimes investors kind of overplay that angle in terms of, what they're focused on.
Do you feel that markets are inefficient in general? And do you think a lot of that has to do with the fact that humans are inefficient?
I mean, that's really what drew me to the stock market to begin with, is just this confluence of economics and numbers and data with a human emotion twist, right? So I guess what's always fascinated me, and it still looks true to this day, is oftentimes the data doesn't change, but the market's interpretation of the data changes. So you can have the same data and the market can be euphoric about it or really depressed about it. And there's always kind of an ex post narrative as to why, but I don't know. To me, if the data doesn't change, why should the interpretation of the data change? So I think as long as humans are making decisions, that kind of behavioral bias or emotional bias just comes into the market. It creates efficiencies. I think that's as true today as it was 40 years ago when computers weren't trading the market. And I think, even if you look at the influence of kind of algorithmic trading, all the quantitative trading in the market, you would think, well, maybe computers aren't emotional, right? So if someone's writing a program, it shouldn't be emotional. But a lot of the computer programs are written to exploit kind of the historical behavior of the market. And because of it, a lot of them are programmed to exploit momentum, which is in some ways a human behavior effect. So, we've looked at some of the studies where investors have run kind of AI optimization programs through, data sets effectively. And oftentimes the AI model wants to emphasize momentum even maybe more than a human would. I don't think things have changed. And that's obviously we're fortunate enough to continue to produce alpha. And I think if markets were efficient, that wouldn't be the case.
I guess part of it is we can see past data, but a lot of investing has to do with what our predictions are of future data. And I guess emotion has to factor in somehow into that analysis.
Yeah, I think you hit the nail on the head, and it's ultimately the future's unknowable, and so we're all in the business of attempting to predict the future. But again, it's hard to predict the future. So really, what we're doing is we're kind of trying to take past data and patterns and extrapolate that. And so if you think about momentum, which is what we're and to some degree we're trying to incorporate that combination value. But there's two ways to think about momentum. One is, I think the way most people think about it, which is price momentum. The stock's going up, it's working. The other is business momentum. And that's really how we try to discern it, in the sense that, a management team may lay out expectations, 5% revenue growth, 20% margins. And then they report their quarters and revenue growth is 7%. So it's better than expected. And that to us is business momentum. It's rate of change. So the business is performing better than expected. And that's, again, kind of a mechanism for generally if things are going better than expected, oftentimes that persistence continues. And inversely, in the same sense, if you have a business where things are starting to go wrong, I think sometimes investors anchor off the historical data set. It used to be a good business with good returns on capital, used to grow a lot, margins compress, they miss revenues, and everyone says, well, it'll go back to being a good business, and that the trend continues and that it erodes. So it's that anchoring effect. It's the historical precedence that leads to expectations of what the future will be. And then the way it differs is it creates those biases and emotion, but just changes in business fundamentals effect.
And which parts of your process do you feel are more timeless, and which parts must adapt as markets and, I guess, competitors evolve?
Yeah, so I still think that when you look at the stock market, the three main attributes that you can effectively exploit as an investor are effectively value, quality, and momentum, right? And as I've always joked, we're trying to incorporate all three of those in our portfolio. There's rarely a perfect three-circle stock, and there's certainly, you would never talk to a professional investor that says, we like to buy low quality businesses where things are going wrong at a really expensive price. So everyone's doing some kind of different shade of gray. We tend to start with price because we think that's important. And I still believe that paying the right price is timeless. I don't think that will change. And then incorporating kind of quality and momentum into that process is still also, in a sense, timeless. There's different ways and kind of factors that feed into that, that we've looked at over time. We do a lot of quantitative front-end modeling. So we blend quantitative research and a team of quantitative analysts with fundamental analysts. And basically, our quantitative analysts, once every 4 or 5 years, will take our factor-based model and they'll take them apart. It's like taking the engine of a plane off and testing all the pieces to make sure it's still working. And they'll test new factors. And it can be changes in the way R&D affects, fundamentals, the way we think about different kind of management signals. And some of that kind of can change if data sets improve. There's just new ways to exploit data to ultimately get to what we think is a fundamental factor. And it's kind of goes back to your comment is, a lot of the data and information is backward looking. You're still trying to extrapolate that into the future. So if there's anything that changes that make it more efficient, but then you see relationships like for a long time in the pre 2000 earnings revisions were, and from 2000 to 2010, earnings revisions didn't really work. In the more recent period, that's been more of a momentum market, earnings revision has worked. So some of these things they can be kind of regime oriented and come back in favor, but it can also be kind of in a confluence with other things and how you're kind of tying the factors together. I mean, one of the factors that we've been kind of using more recently is like an idiosyncratic beta factor, basically, is the stock behaving the way it has normally, or is it changing? And there's information there, right? If you think about your average stock where the company's doing well, they're hitting numbers, the business is doing well, the stock is performing, the market's comfortable with the story. And then all of a sudden a fight breaks out in the sense that investors are starting to kind of think about a situation, maybe risk is popping up, there's a change in trend. The stock will start behaving differently. And that can basically be kind of a situation where you can get ahead of changes in price momentum. So it's really just testing those different factors to see what can effectively make the timeless part of investing, or we could still exploit it. So I think that the focus on value, quality, and momentum as main factors that to some degree, again, every investor is trying to exploit different elements of them. A growth or momentum investor, they really just want good businesses with definably good momentum, and they don't care about the price they're going to pay. And inversely, you have deep value investors that don't care about quality. They don't care about momentum. They're just trying to buy the cheapest stuff in the market. They're catching the proverbial falling knife. Everyone's kind of operating within that realm. It's just really kind of where their focus is in. And then it's kind of on the margin. What tools are you using to basically exploit kind of finding that angle? And then the discipline around what you're doing it.
Would you talk about your emphasis on filtering over forecasting?
Yeah, I guess our take is that if you think of it, ultimately we're building our portfolios on a bottom-up basis, as many kind of fundamental investors are that are trying to stock pick and add value through stock picking. I think this is kind of my take, just an observation. It's to some degree anecdotal, but if you think about a lot of fundamental investors, it's humans going out, scouring the universe, looking for ideas. And oftentimes what they're doing is they're meeting with management teams, they're hearing the story, and the management teams are out. They want their stock to go up. That's how they're getting paid. And they've got a slide deck and a presentation as to how you should think about investing in the company and what their story is. And so investors will say, okay, I like this story. It sounds really good. And then they'll go back and do the due diligence as to kind of fact check that information, create an investment thesis, and make their decision around it. That's, again, it kind of anecdotal, but a lot of that's what's going on for a lot of fundamental investors. If you think about human behavior is, we're just biologically wired towards stories and narratives. It's how we're wired. The issue with that is that a lot of times investors decide they like the story. It's created a bias where they want to kind of get the data to fit to confirm that the story sounds good, so they can go ahead and invest in what is a good sounding story. And it just can create risk. So our big focus is really starting with the quant data and letting the quant data tell us where the opportunities are, and then going through and doing the due diligence and kind of thinking about the story. And so it sounds really simple, but there's kind of power in letting the data tell us kind of where to go. And so, you could have a situation where our quant model is saying, look, the valuation of the stock is good, the profitability is good, estimates keep getting revised up, things seem to be going well. And inherently, that probably means there's some skepticism in the market, because if you've got good value and good fundamentals and things are getting better, it usually means there's a narrative as to why you shouldn't pay attention to that. So the data is telling us, look, think about this. You take this situation seriously, analyze it, and it may be that the model is, missing something. It's, again, the model is probabilistic. It's not deterministic, but it puts us in a position to kind of think from a contrarian standpoint. And inversely, you could have a situation where the story is really good. The stock may even be going up, but the quant model can say, hey, look, there's extreme valuation, poor profitability, numbers keep getting revised down. So the market's just sticking with the story, but the data's quite risky. And that keeps us out of, a lot of stuff that I think investors create errors on. And, as it relates to our long short products, what we've actually found with our quant model is, the quant model is really effective at finding winners in the market. companies that are going to outperform, but it's even better at finding failure, companies that are likely to underperform the market. So it has a really high hit rate in terms of failure identification with a high alpha tail. And effectively what it's doing is it's modeling the behavior that a lot of investors do to make mistakes, which is they buy into the story without looking at the data, without confirming the information, and they get into risky situations. So one of my favorite economics professors in college used to say, take a complex situation and simplify it. And so if I've kind of said to investors, and they're trying to kind of understand our process between the quant work and the fundamental work, if I had to only take one of the two, on the long side, I take our fundamental analysts. On the short side, I actually take the quant model because it's just so good at identifying failure. And I think again, that relates to the fact that you can't sit down with a management team and say, why should I short your stock, right? Give me a good story for why your stock's going to go down. It's usually they're selling a good story and the data is saying otherwise. And that's why the quant models are so productive that way. So, that was maybe more detail than you wanted to, but I think it's really important to kind of how we bridge them together and work through that information flow to kind of keep a really disciplined process.
You mentioned 3 market anomalies that you feel will have persisted. Low price beats high price, business momentum works, and quality works. Why do you feel these persist?
It's a good question. And I think just to kind of provide context, I think in terms of value, I think sometimes the world breaks these factors down into value versus growth. But I think it's an important distinction to say, look, growth is a component of value. So earnings growth is something, it's a part of valuation. So I've always thought about it as you alluded to, so it's kind of wanted to emphasize it. It's whether if you're a value investor, you're generally buying lower multiple stocks, higher yielding stocks. And if you're what the market defines as growth investors, you're willing to pay higher multiples for companies to buy into that. I think the value anomaly works largely because I still think businesses are ultimately competitive over time. That when you have a high yielding stock or a low PE stock, the market is overly discounting kind of the problems. And oftentimes businesses or management teams can be fixed. Situations can be turned around. There's cyclical situations where things mean revert. And inversely, really high price stocks are signals that the market's placing a high emphasis on returns and growth. And oftentimes the market's good at ultimately coming in and kind of eroding that competitive advantage. So, and there was a long period of time where the consumer staple stocks were kind of darlings. And, we've seen some of that unwind in the last 5 or 6 years. They used to be 25, 30 times earnings businesses because the market said they had tons of pricing power and could grow and good margins and competitive moats. And, we've seen pretty disastrous returns from a lot of those stocks for a while as they've seen margin compression, deterioration in their growth rates. And as a result, the multiples have compressed. So as it relates to value, and you just look at the history of the stock market, generally stocks over 30, 35 times P, they have a pretty high failure rate. We can talk about it, but the Mag 6, I call it the Mag 6, I exclude Tesla, but they've kind of defied that. They're quasi monopolies. So they're a bit of an anomaly, but ultimately that's why I think value works. Quality I think just works. It's less that if you think about really high return on capital businesses, companies that consistently out earn their cost of capital, there's not a ton of them, and the market's pretty good at identifying them. So to me, a lot of the quality data that comes through, a lot of it is kind of rate of change. And it's also just the market every once in a while when it's in a speculative behavior, people are willing to speculate on low quality companies, and that usually unravels. So if you just have a persistent quality bias, you'll tend to kind of avoid that. So you're basically avoiding failure. And I think to some degree, if you take businesses and I think quality is something that also should be analyzed on the margin. And this is to some degree momentum. Whereas if you have a lower return on capital business where on the margin things are improving, return on capital is going up, it's super productive. If you have a high return on capital business where on the margin returns are compressing, that can be a destructive situation. So there's a rate of change there that I think is important. And then I think momentum is kind of, we were talking about earlier, that persistence there is just because of its ability to kind of help the market extract from what has happened to what is happening and trying to kind of differentiate that bridge, basically.
But isn't it hard to get all 3? Meaning you may find a company with strong business momentum and high quality. So those factors may be strong, but maybe the price isn't exactly what you're looking for. How do you deal with that?
Yeah, it's so. And we tell our investors, prospective investors, that are like, look, there's no perfect three circle stock, and so the way we kind of think about it is everything in our portfolio, because we're value investors, has to have a value angle. So you really won't see stuff like 30, 35, 40 times earnings where we're just paying through the nose to just buy quality and momentum. But oftentimes the bigger positions in our portfolio won't necessarily be the cheaper stocks. The markets, we have some stuff 15, 16, 17 times earnings, where the international portfolio that I run on average is 12 times earnings. So they're actually in the continent, relative to the market, they're still reasonably priced. They're really high quality businesses with definably good momentum, but they're not the cheapest stocks in our portfolio. And then kind of the smaller stocks in our portfolio, I kind of call them the two circle stocks that hopefully will turn into three circle stocks. So they have more of what you would kind of think about as a deep value profile. So much cheaper, but we're giving up some quality and momentum. The way I kind of think about it is I could have 5 new ideas from 5 different analysts, and they come in and they said, we've run a quantitative screen here actually for, really good valuation, decent fundamentals, but negative momentum, i.e. the stock's out of favor quantitatively. They've done some due diligence and they've come to a conclusion that the reasons the business has been under pressure and is super cheap is about to change. Management's going to start fixing the certain issues, improve margins, revenues are going to go up, that kind of thing. So what they've basically done is they said, look, I've got a stock with significant upside, but it's got more of a deep value profile, right? Could be 40 to 50% upside to target price, but I'll immediately say, all right, I know that looks like a lower probability event, i.e. the business is slightly lower quality and it has negative momentum. But I say, look, it's a very reasonable thesis. And I say, I've got 5 of those from 5 different analysts. I say, I may agree with all 5 of you. And what I'll do is I'll take 0.5% in all 5 positions. And I think at that point, what I need to know is we're probably not going to get all 5 of them right. Again, deep value investing is a big payoff, but lower probability of hit rate. Hopefully we're right on 3 out of the 5. And what I need to do as a portfolio manager is recognize the 3 out of the 5 that we're getting right, i.e. the stocks, the data points have started to confirm the thesis. The stocks have traded up 10 or 15%. That means that momentum is improving. That's, from our original target price, they could still have 25, 30, 35% to go. Those are stocks we're actually adding to, making bigger positions because there's still good upside, not as much as we originally went into it, but still quite a bit, and momentum's improving. So it's effectively the thesis is being de-risked. And the other 2 out of 5 are persistently good upside to target price, but broken theses, which those are just stocks that are value traps. So, in any given year, there's going to be stuff we get right. There's going to be stuff we get wrong. You hope on average we're getting more right than we get wrong. And the faster I can figure out as a portfolio manager what we're getting wrong, get it out of the portfolio or shrink it to a really small position and wait for the timing to be right and add to the stuff where we're getting right, the better off we've been. And that's, to me, also, I think what's been productive about Boston Partners is, you think about your average value investor, they can be a stubborn bunch. There's value here. Like I should sit and wait it out. But statistically, if you look at the data, you really shouldn't. You're just falling trap to value trap. So you should really kind of focus on it's again, easy to identify value. It's hard to find the value that's going to work. So kind of getting in that mind frame and not being stubborn is a really important part, in my opinion, about investing.
So I understand that you tend to avoid big macro calls in terms of your analysis. So how do you navigate potential major regime shifts without becoming a macro forecaster?
It's a fair question. So the way I kind of simplify it, and just my observation over time, I think if you think about investing in 3 buckets, at least in the equity markets, the first one is you get your stocks right, but you get the macro wrong. You'll still make money over time. You'll make alpha. The second one is you get the macro right and you get your stocks wrong. You don't want to be in that bucket because it's just the business failure, companies struggling. Even if you're kind of getting the themes right, you'll actually underperform if you kind of look at the data. And the third is you get your stocks right and you get the macro right. You'll make a lot of money. Ideally, you're kind of in the third bucket, so we have to have opinions. But I think just given the kind of prisoner's dilemma of those 3, you want to get your companies right. So our focus is on getting the companies right, getting it right on a bottom-up basis. But we'll form opinions about the world. You don't want to get in a position where you're saying, I think this trend is happening. I think it's really important, and I'm going to force this on my positions. The positions really have to reflect what we think ultimately work, which is, value, quality, and momentum. But if we can kind of identify what's going on in the world and get that in confluence with the bottom up, it's super productive. I think you look at a few trends in the last few years. We went through that period where interest rates were declining, right? And that was a difficult period for our firm, 2018, 2019, 2020. And as rates were going down, the market said this is a duration effect, which in itself is fine. If your cost of capital is going down, then you can expand multiples. But it didn't really pass the litmus test because we saw high multiple businesses going up and we saw cheap stocks going down in absolute price. Now, if cost of capital is going down, everything should be going up, even if you duration affect it. So yes, you can get more multiple expansion on longer duration businesses, but you shouldn't see multiple compression in lower stocks. So if you kind of think about the trend and then think about it on a bottom up basis, it should litmus test in the sense that it should make sense. And if it doesn't, we tend to avoid it. And we said, look, we went to investors and said, what's going on doesn't really make sense if you look at the data. Periods like this have gone on in the past, but we're going to kind of avoid what we think is ultimately a mistake. That proved to be right. And now, and a common kind of question we get is, reflecting on that period, would you do anything differently? And I still would say kind of no, because if you look at the data, I could have said, well, I think this goes on for 3 years, so I'm going to go out and buy super high multiple businesses where you're really overpaying for them, because I think it's going to go on for 3 years and then it goes on for 12 months and it unwinds and you've impaired capital. And I think that's a bad decision. So we kind of try to focus it from a risk standpoint. Say, all right, where it makes sense, we'll continue to try to kind of protect capital and do well through these periods. But ultimately, when things mean revert, we'll tend to make more money than we'll give up during those periods. And that's a discipline we've kind of experienced over time. So again, relating to kind of that question, I think it's important to kind of understand what's going on. I think sometimes investors overemphasize, we don't pay attention to the macro at all, which I think is silly. Now, I think there's some really important things going on in the world right now, but I think just from the context of, the macro's hard to get right. It's hard to get the timing right. And then again, if you're getting it right, but you're getting your companies wrong, it really just doesn't matter.
And of course, a macro perspective feeds into your bottom-up analysis as well. So they're related in that regard.
Yes. So, I mean, for a while, it was pretty obvious that when the BOJ was in a kind of a rate suppression environment where the yen would weaken, there was an explicit policy and our investors expect to earn dollar-based returns. So we're going to be really price sensitive to owning effectively local yen businesses in the sense that we need to make enough money in local yen terms to compensate for that yen weakness. That wasn't necessarily, I think about that as kind of, it is a top-down element, but it's important because it's impacting how we're kind of thinking about companies and picking stocks.
You talked about a quantitative as well as qualitative analysis. Where does the quant screen formally hand off to the analyst? At what point?
Yeah, so basically the way the quant model works is we have 8 quantitative analysts. They've built and maintained a proprietary quant model, and effectively that data is rerun weekly. And our process is, I kind of think about the fundamentally analyst work is twofold. One is maintenance research. So this is, they'll constantly get a list of the stocks in our portfolios that are approaching target price. And those are stocks where they have to kind of revisit. It could be a buy thesis that's worked, stocks approaching target price. They could be downgrading their recommendation to hold, but continue to hold. Business has got good momentum, initially conservative target price. Or it could be we've got a buy recommendation and there's some information that comes in and changes their thesis and they have to go through that, digest it, change their recommendation, and speak to the portfolio managers about. That's all in the context of maintenance research. And then it's new idea generation. So the analysts are expected to review the quant model on a weekly basis for new ideas. And then the portfolio managers were active idea generators. I spend a good bit of my day kind of reviewing, again, the same stuff, what's approaching target price in the portfolio, what may be the value traps in the portfolio, then looking for new ideas, and it's reviewing the quant model. Having been an analyst at Boston Partners, pretty much all our portfolio managers have been. I'm very proficient with the quant model and then kind of going through it. And there may be 2 or 3 ideas that I think are interesting. And what the quant model is, it really kind of helps you dive in quickly on kind of what the factors are. And it's again, as we've spoken about, it's not as simple as just kind of the confluence of all 3 factors. We can run screens in our quant model for value with fundamentals but negative momentum, or value with momentum. And if I can see kind of what the quant model is telling me at the data, I can then pretty quickly dig into the company. And usually I can do enough due diligence, even as a portfolio manager, to say, hey, I think this is a legitimate three circles idea. And then at that point, I would hand it off to the fundamental analyst to do extremely thorough due diligence. And they're effectively doing the same thing on a weekly basis. So they'll go through the quant model, they'll start to look at the idea to kind of then determine whether kind of the quant model is leading them in the right direction. And if they think so, then they'll decide. And usually we basically, our director of research sets a weekly agenda, and the analysts are reporting on that new idea generation. And it's usually I hop on with all my analysts and they'll say, I'm going to look at company XYZ. And I'll say, can you also look at this company? And at that point, they're going to basically fully put the quant model aside and dig in and do very thorough fundamental due diligence. So, modeling the company, annual reports, industry research, meeting the management team, everything that you would think of that incorporates very thorough fundamental due diligence to ultimately create a thesis.
Are there any aspects of the three circles that you feel are either counterintuitive or non-consensus?
It's really, to me, thinking about momentum as business momentum is really powerful. So, one example is just, I run our international equity. A year ago, Europe was super out of favor. It's like a 4 standard deviation event from a valuation standpoint. Trump had just been elected. Everyone thought he was going to really punish non-US markets. The dollar had rallied. And what was interesting in our quant model is that the quant model actually said there was, with the exception of price momentum, there was really good momentum in those businesses. So the businesses were doing really well, but the market had a narrative on a top-down basis why they should. So I think our focus, you incorporate a little bit of price momentum in our momentum factors, but a lot of it is really on business momentum, which is really kind of rate of change. I think it's a really nice and subtle way. I don't think a lot of investors think about it. I think they simplify momentum as just the stock working or is it not? And if you could go in and say, well, the stock's not working, but business momentum's quite good, and the quant model actually kind of confirms that with certain other signals that we use, there's subtleties there that I think are quite powerful. And it also just creates the right mindset for investors or analysts to think through and say, hey, I know the stock's not working, but the business is doing quite well. And that's usually when that happens, it's quite productive.
I suppose that's also a good way to avoid the deep value trap, right? Meaning you're looking at the underlying business fundamentals and not just the price.
Yes, exactly. And that's you can see businesses where if they're there's value there, but they're persistently kind of missing numbers or things are going wrong. I've learned quite humbly in my career, it's generally better to pull the trigger and get out faster than to try to be patient. Generally, when things are going wrong, they tend to get worse than you expect.
So we talked about how humans can be inefficient and have these biases. Are there any practices that you use to help counter the narrative and confirmation bias?
I usually kind of ask the analyst just to really dig in on incremental numbers. Even when you train analysts to think about the world very numerically, I think it's very easy to just get caught up in the story, especially when I think there's expertise in having sector-based analysts, but I think even when you do, they can still get sucked into the narrative. So I spend a lot of time talking to the analysts about the numbers. If this is true, why are the numbers doing this? If the numbers are really good and you're telling me things aren't that great, why are they keep beating numbers? So it's just kind of constantly mentally checking the narrative with the numbers, and thinking about it from a different perspective really kind of forces the thinking. And to me, that's really kind of the most important thing in terms of just kind of making sure there's no confirming biases, there's no narrative biases, that kind of thing.
Yeah, storytelling can be very compelling.
Yep.
So I know Boston Partners suggests alpha is strongest potentially when markets overreact. What kinds of overreactions do you look for, and how do you exploit those dislocations?
Yeah. So, I think, some of the sectors that we've done really well in are sectors where you actually have higher quality businesses, but oftentimes cyclical sectors. Like industrials has been a really good sector for us, particularly in international over time. And you think about the international markets, there's a lot of great industrial businesses in Japan and Europe. And it's always something's going wrong in Europe, something's going wrong in the world. People don't like the macro. There's a dislocation, and you get these incredibly high quality businesses on sale. And, ultimately economies grow over time. So you get to these points where people kind of get really negative, and you can exploit that. So and even in sectors like materials, investors really have oftentimes a low threshold for pain and cyclicality. And you take like chemicals companies, and we're not heavily invested in them today, but there's been times before they can be great businesses and they're an integral part of the economy. So, but just because they're cyclicals, again, something goes wrong on a top-down perspective, and the market tends to overreact, and you create a lot of opportunities. So, it's to me, a lot of it comes from the top down, and the way the market just, again, behaviorally overreacts, and it creates an opportunity to own what can be, again, cyclical businesses, but higher quality companies that generate good returns, grow, generate lots of cash flow. And oftentimes those businesses are really good at kind of counter-cyclically investing. So they can go through periods where they overinvest and periods where they underinvest, and that creates a lot of opportunities. We're seeing it in metals and mining today. There's been a lot of underinvestment for a long time. They're historically very difficult businesses, but if you're underinvesting and your return on capital goes up and the market doesn't buy into that, you can exploit that.
Is that one of the reasons you're bullish on metals?
Yeah, the metals to me is a super exciting space. To caveat it, I used to be our energy and metals and mining analyst before being a generalist. So it's a space I've kind of watched for a long time. But I think, in some ways, energy and metals and mining are simple cycles. They're historically kind of 5 to 7 year cycles of overinvestment and underinvestment. And you can just measure that by capex to depreciation. So the rate at which companies are reinvesting in their asset bases. The rule of thumb is when they're reinvesting at high rates of reinvestment, so over 2 times capex to depreciation, you generally want to run from the hills, or just kind of run away from the sector, that they're going to destroy returns. And when they're under investing, the market is usually coming out of a cycle where they've destroyed capital and the market's super frustrated with them, and usually things tighten. What's kind of unique about the metal space right now is we have some really big kind of things percolating up. One is they've been through an underinvestment cycle. There's, everyone's read kind of what's gone on with, it's hard to build a new copper mine. But then you have this weird dynamic where China's gone around and kind of controlled a lot of these supply chains. So like I was just meeting with a small little company that produces tungsten. 80% of the world's tungsten's coming out of China. And China's not exporting it anymore. And it's a critical mineral. You've seen the US government go ahead and list all these critical minerals that they need to rebuild stockpiles. So you have this confluence of underinvestment in just from a normal cycle standpoint, with some really weird things that have gone on in supply chains in terms of how China's just kind of controlled them, and then the geopolitics at play. So it's playing out to be a really big metal cycle. Personally, I think it's going to be substantially bigger than what people will even kind of expect now. And we've seen some really big moves in these markets. And I think it may get to the point where companies start to come out and say, hey, we're having a hard time getting raw material. It'll start affecting supply chains. And then you take the other angle and just gold and silver, and, some of the kind of monetary changes that we're seeing with how central banks accumulate gold as a reserve asset is putting pressure on the debt markets. So I think, and you're seeing gold kind of track in lockstep with the Japanese yen, or the yields on the Japanese government bonds. So you overhit demand from a monetary standpoint, and then just kind of the supply chain dynamics of these minerals, and it's just setting up for being one of the biggest metal cycles of all time, in my opinion.
Do you feel like we're near an inflection point in demand for alternative storeholds of wealth like gold?
I do. I think what's interesting about gold is to me, it's in some sense you could say it's, as Warren Buffett said, it's a pet rock, right? It doesn't yield. Over maybe 50 or 60 years, we'd be better off investing in businesses that grow and generate profits. I don't disagree with that. But it's also a physical element that's been around for multi-millennia and survived a lot of fiat currencies. So the people that have said, all right, there's clearly kind of a debt-based finance that's pretty out of control in some sense. You look at interest costs as a percent of GDP, they're basically on the verge of out earning nominal GDP, which is not good. But I think there was fatigue in that thesis post GFC, because everyone kind of thought that would be an issue. And then we saw kind of quantitative easing. But quantitative easing at the time, it was, through what ended up being a strong dollar cycle. It was in that period deflationary, and there was a lot of recycling of foreign capital into the U.S. market. So it dampened volatility and added liquidity, or kind of the same thing, and really kind of helped the market. But what changed in the pandemic was, there was more government deficit spending, and you saw just much bigger inflation dynamics, and now you have kind of this deglobalization trend. And now capital, all the capital recycling, the U.S. runs a big current account deficit, runs a big federal deficit. And the funding of that from foreign countries is starting to go away. The BRIC countries are buying gold in terms of their kind of reserve accumulation. And then you're seeing interest rates go up in Japan. And Japan's kind of ground zero for all this. Rates went down in Japan first. And everyone kept saying they would never go lower, and they continued to go lower. And then everyone said, well, it's a Japan problem. And then it was a Western world problem when we saw rates go down, 0 to negative. And now rates are going up in Japan. And to me, they're just kind of a step ahead of everyone. So as rates go down, if you're in a secular bear market for bonds, I think that will create demand for real assets. And I also think if there's, as the market has said, well, if we get QE, that I'll just buy the NASDAQ. And that's what worked last cycle. When you're doing QE, you're just getting kind of financial repression, right? Like it's just, and the money can go wherever it wants to. So it could go into hard assets. I kind of think it will. So, on paper, the last year was a huge year for gold and silver. But just from where we've been from asset and asset allocation standpoint, it could go a lot higher. I mean, I think from some of the estimates I've seen, allocations to gold are still sub 1% of your average investor. They peaked in the 70s around 5-6%. Those are big numbers. So if you kind of buy into those trends, it certainly could go on for a lot longer than what we've seen.
An interesting data point that I always find fascinating is gold, shiny yellow metal, has outperformed the S&P over the last 25 years.
Yeah, and it's been a really good cycle for the market. So, and I've always kind of looked at gold and said, like, again, kind of that, I have to hold it for 50 years? And on the last 25, you would have been well off doing it. But I would still think you'd on average want to own stocks. But you go through periods of real stress, the 1930s, the 1970s, and there were, it was a huge alpha generator. And we've been actively investing in some of the gold miners. And the gold miners undoubtedly are very difficult businesses. You're taking a room full of rock, crushing it down to a gram of gold. The operating leverage is huge. They operate in difficult jurisdictions. And they historically destroyed a lot of capital, but because they had destroyed a lot of capital, the capital allocation is a lot better today. At some point, they may change that decision, but the companies are focused on productive mines that are low cost. They're trying to manage risk, just generate cash, and the margins are just astronomically high. And we have businesses on 25% free cash flow yields with a management committed to returning capital to shareholders. So that's the market saying they don't even buy into the gold price. And that's, again, you go into periods of stress that can be a huge alpha generator. And I'm a little bit more bearish on the market this year. And it's part of the portfolio we're still super excited about.
Do you believe that non-US markets are generally less efficient than US markets?
I think when you look at markets, I mean, it's been a while since I looked at the data, but the last time I saw there was 3 to 4 times the amount of fundamental analysts per market cap in the US market than there are in non-US markets. So just in the sense that it's kind of the most developed, biggest capital market in the world where everyone's trying to get an edge, it still generally looks to me like the US is the most efficient capital market, but I don't know. Then you look at situations like how Tesla's valued, and I guess you could question that. Generally, I would say the US is still kind of the most efficient capital market in the world.
So if we look at US mega cap, those companies dominate while international markets generally trade at a discount. What do you think could flip the leadership, and what could invalidate that thesis?
Yeah, so when you break the S&P 500 down, there's a couple interesting ways to look at it, right? One is what's happened, obviously, is with and everyone knows this. So with the again, can I refer to it as the Mag 6? Because Tesla's just its own beast, if you will. The Mag, NVIDIA is an incredible company. Microsoft's an incredible company. Google's an incredible company. They're very good companies. High returns on capital, lots of cash generation. They've defied gravity for a long time. but they are kind of monopolies, and the US government has effectively allowed them to exist. Doesn't look like that's going to change. But what's happened is because they've done so well and you've had all this money go into passives to just participate, which naturally makes sense. The returns have been really good and the cost of entry is low. It's also brought up the valuations of everything else. So if you look at like the S&P 494, you're paying on average like 18 times earnings for them. And the rate of earnings growth is low single digits. So the economics of those businesses actually for the price you're paying aren't that great. So to me, the entire US market is just riding on those stocks, not literally from their weight of concentration. It's just those dynamics. Like I don't think the rest of the market can really bail them out in terms of, again, the rate of earnings growth versus what you're paying for them. So then you kind of have to say what happens with those stocks. And there is a sheer element of just their pure size, right? They're how big they are to just the economic output of the world. It's hard on the margin to continue to earn rents. I think what's unique about the AI cycle that's very different than the kind of the cloud and the cycle before was the incremental free cash flow margins when Microsoft was growing in the last 10 years, when Meta was growing, when Google were huge. So the rate of cash generation per incremental dollar of revenue was exceedingly high. And that's ultimately what allowed them to compound. What's different about AI is it's properly capital intensive. You're looking at rates of capital investment at like 4 to 5 times depreciation. That's like what energy companies were when they were really behaving badly from a destroying capital standpoint. So I think there's just much bigger question marks about how efficient AI is. I don't have any doubts that it's going to have a big impact on our lives over time, but we may have to transition to more efficient AI. And when you look at that, to me, Google's kind of the winner, I think. And I think NVIDIA could really stumble at some point because they're still just selling chips. And I still think there's issues with OpenAI and how they fund it. So all it would take would be NVIDIA stumbles. That takes some wind out of the market. And then, Microsoft kind of, personally, I think it's a good business here, a great business, but the growth story could slow. And they don't have an incredible AI product. So all you would need is a little bit of crack there to take a little bit of wind out of the US market. And at the same time, I still think we're going to go through a dollar weakening cycle. So if you look at like the international that I run, it's on 12 times earnings for 12% expected earnings growth. So you have a really good combination of, again, to me, 12 times earnings for 12% earnings growth is much better than the S&P 494, 18 times for like 3% earnings growth. That should be a winning combination over time. But what's held that back for the last few years is the market's been kind of pulled into the US market for the mega cap stocks and the dollar strength. And as the dollar strength weakens, I still think that trend continues. I think Trump's pursuing a weak dollar policy. Real rate differentials would still suggest the dollar is expensive, and it tends to mean revert over time. So if returns are better to non-US stocks from a dollar standpoint, and you have attractive economics, and then you get a crack in the Mag 6, kind of exacerbate a trend that I think slowly started last year. I mean, the international was up 40% last year, slightly more. And that was a year where the big US tech stocks still did well. So you get into an environment where the dollar trend accelerates to the downside and they get cracked, you could see kind of big changes.
So is your sense that the AI-driven concentration has gone too far and we're near the end of that cycle?
It feels a little frothy. I mean, the rate of data center build in terms of what it's doing to electricity prices versus like what the company's kind of expected return on investment. It just looks like we could have an air pocket. I think it's just one of these things where it's, the answer is never black or white. It's always a little gray, that the trend is real, but we've over extrapolated. There's too much spending and we just need a digestion period. And that digestion period, it doesn't take a lot to put some of those big tech stocks down 25, 30%. And that would really kind of knock the market around.
And how do you distinguish truly AI-enabled firms from companies with AI-heavy narratives, but little, profit and loss evidence?
I mean, I wish I had a perfect answer for you. I mean, so far, it looks like Google's kind of doing the best job with integrating an AI model that's actually economically efficient. But even there, it's kind of hard to understand what they're generating on AI and how it will actually eat into their traditional search revenues. So, like we're using, I'm sure as everyone is, we're using Gemini and we looked at the models. But how it kind of the value proposition versus the rate at which a lot of these companies are spending, to me, is still kind of questionable at this point. So I think what will be interesting is what are businesses willing to pay for these AI models versus what it costs these companies to run the AI models for the companies is again a big issue. But I right now we're at the point of investment where the tech companies are saying, look, we have to build an AI backbone and testing, and that's causing all this chip demand and data center demand, because if we don't, the rate of kind of competitiveness in the tech world, where if you're left behind, it just destroys your entire company. So again, we're going to go into this transition where we kind of get everyone has a model, and now it's like, all right, who has an efficient model and what are its business uses? And I still think we're in the early innings of that.
And it seems that maybe some of the winners of the AI innovation cycle are not tech companies. They're all the other companies that learn to use AI and to increase efficiencies and grow their business faster.
Yeah, and I think that's where, healthcare has been through a really tough patch, and it's been kind of a poor sector for a while. I mean, to me, that would be a very obvious way where AI starts to really kind of positively impact, return on R&D, and you're not paying for it for the healthcare companies. So I think it's a sector we're certainly digging around in a lot more. The only thing that I kind of, at least as it relates to international, it's less relevant for our US. There's a lot of the healthcare companies are big dollar earners, and it's probably come across a big dollar bear here. So, the U.S. healthcare system obviously is a huge system, but again, I think AI there is a big deal.
How are you positioning portfolios amid these rising geopolitical tensions that we're facing, and how do you do it in a way where you're try to protect against the downside without missing the upside?
Yeah, so I think if it was generally our take a year ago that Trump would be a little bit more aggressive on tariffs than people thought. This would be a more populist presidency. So we spent a lot of time just thinking about, supply chains, like talking to industrial companies and making sure that they could kind of manage through their supply chains. And so there's an element of, there's businesses there that we really like that are benefiting from electrification trends. So trends that are just kind of naturally occurring within in the economy, but can manage through some of those geopolitical risks. So we spend a lot of time on understanding if companies have supply chains out of China, how much revenues they source there. So in some sense, it's an ability to kind of express both basically the underlying kind of economics of the business, but also just risk adjust for what is effectively uncertain policy. It's never perfect. It's always an exercise in just kind of discipline around just doing your due diligence, understanding the companies, understanding how the management teams are thinking about things and risk, but trying to kind of maybe not get caught up too much in all the geopolitics. And then, I guess our general take is that the crazier this stuff gets, the better it is for some of the metals markets, which is so you have pockets of your portfolio that can benefit there. And then you have cyclical parts of your portfolio that are just benefiting from trends that we think can kind of earn through some of those cycles where the management teams, again, have kind of hedged those risks. And ultimately, it's, that's been working so far. I'm sure we won't get everything right, but it's just trying to kind of think ahead, and just be open-minded.
The other dynamic that we're experiencing is global central banks are diverging in their policies. How do you feel the shifting rate regimes influence relative value between US and international markets?
To me, it's a big deal. If you look at the developed markets in terms of the FX markets, predicting currencies is hard, but ultimately currencies are trading off of kind of real rate differentials and current account deficit surpluses. And it's in EM, if you think about the world, dollar vis-a-vis EM, current account deficit surpluses are a big deal. In the developed markets, it tends to be more real rate differentials that are driving it. So, quite simply, if you go back to 2010, post GFC, the dollar was actually quite cheap on a real rate differential basis versus a basket of pounds, euros, and yen. This is like a 2 standard deviation event to normal. Normal would be kind of real rate parity. And that was back then. Everyone said they loved EM. They hated the dollar, the US dollar. They hated the US stock market. And, you wanted to step up and buy the US market, and you got a tailwind from the dollar. And non-US markets relative to the US market didn't look that great. and they had a headwind, currency headwind. Now that's unwound. And, coming into last year, we were at a 4 standard deviation event from valuations in non-US markets versus the US market. So very extreme, even relative to their normal discount.
And the narrative is the other way.
And the narrative's the other way. And the currency was at the US dollar because the US economy had been so strong, the Fed had raised rates so much that the dollar was about a 2 standard deviation event expensive on a real rate parity basis to its normal trend. And I think about that as mean reverting. So again, I think Trump wants he's focused on middle America and bringing manufacturing back. And he wants a weak dollar. He said the rest of the world has ripped off the US economy or the US. I mean, so that's what he's doing. And so he's weakening the dollar. And just simply put, when you've got good valuations and good fundamentals abroad and that tailwind of a weaker dollar, it's just really productive. You do have to then focus on where companies generate revenues and where their cost bases come from, because US economy's big. And so if you're a big dollar earner and you're in Europe and you're going to see translational negative earnings revisions from your dollar sourced earnings. So those are all things we're really focused on. But I think this is a big trend. I don't see why it's going to change. And it's like you look at like a year ago and everyone was really negative on Europe and they said the US growth is better. But I was like, the US is running like a 6% deficit. Germany's running a 1% deficit. If Germany runs a 6% deficit, GDP growth will be a lot better there. So you have to kind of look at this stuff. And it's Japan, like I said, it's a big deal. It's been really good for their market, but they've had a really weak yen. And now they've got spiking interest rates, and that can reverberate everywhere in the world. We've seen, August. It was August of not last year, but 24, excuse me, where we saw kind of the market reprice a little bit of the carry trade, and you saw that. So you get into a cycle here where, Trump gets his way with a new Fed governor and they're aggressively cutting a lot more than the market's discounting, and they're getting slow rate rises in Japan, and you're going to have kind of capital that gets pulled back into Japan away from the non-US market. So there's a lot of things changing in the world. And I think this context of, yes, I get that middle America has been gutted, but the US, if you look at the US economy, it's very dependent on the equity markets, right? I mean, household net worth in Europe to the equity market is only about 20%. It's only about 10% in Japan, but it's up to like 50% in the US. So it's, the US market goes down and it negatively impacts the US economy much more than it does in non-US markets. And so all that capital that's generally been recycled from the rest of the world into the US stock market has created a wealth effect that's supported the economy here. And you're already seeing us with some Danish pension funds just came out and they're upset about what's going on with Greenland, that they're going to start pulling their treasury investments. We've seen the BRICS do it. And just the way the capital's recycled, it impacts markets. So if you have a negative wealth effect from what's going on that's structural, it puts pressure on bonds. Ultimately that will have to be financed out of the bank reserves in the US economy, which crowds out the equity market. So you could go into a long secular bear market. I don't think you see something like a big crash unless you had a really big geopolitical event, like China takes Taiwan or something like that. But you could really derate the market slowly over time, where you have a lot of up and down. Like we saw in April last year, you go down, you go back up, you go down, and slowly over time, the market's flat over 5 or 10 years or low single digit returns. And in real terms, it's much worse than that. And I would expect bonds to be even worse. So just the capital dynamics in the world are, I think, much more conducive to that kind of outcome than they have been in a long time. And I think that's a big risk for investors. I think your average investors, that's where passive could end up hurting. We run a long short, had good returns for the last 4 or 5 years, and I'm pretty excited about it because that kind of environment, it would be great for that fund.
It is interesting. A lot of the cycles that you described are self-reinforcing, and they continue until they hit extremes, and then they self-correct, and then the self-reinforcing goes the other way. And it just does feel like we're at an inflection point among a lot of those cycles.
Yeah, I mean, bond markets are like 40-year cycles, right? Yields were up until 1980. They were down for 4 years. 2020, we may be in the early innings of a really long kind of rising interest rate environment. So the world's always changed, right? It's always evolved, but in some ways it's not different. That's what makes it fun.
And it goes back to what you said in the very beginning. Humans are pretty inefficient and they influence markets all day long.
Yep.
Well, Josh, this has been fascinating. Thanks for taking the time, sharing your insights and all of your perspectives. I appreciate it. And I know our listeners do as well. Thank you.
Great. Thanks, Alex. I really enjoyed our conversation. I appreciate your time.
Thanks for listening. We hope you enjoyed this episode. Please visit our website at insightfulinvestor.org to access past shows and learn more about our podcast. If you have questions, feel free to email us at info@insightfulinvestor.org. And if you enjoyed the discussion, please subscribe to this podcast to ensure you don't miss future episodes. And don't forget to forward today's conversation to others you think would enjoy listening. Important information. This podcast is provided for informational purposes only and should not be considered legal, tax, investment, or business advice. It is not a solicitation, recommendation, or endorsement. All opinions expressed by participants are their own and do not necessarily reflect the views of the Evoke Advisors Division of MAI Capital Management, LLC, or Evoke, its affiliates, or any companies mentioned. Information shared has not been independently verified by MAI or its affiliates. MAI Capital Management, LLC, or MAI, is registered with the U.S. Securities and Exchange Commission, SEC, which does not imply any particular level of skill or training. Certain information contained herein has been obtained from third-party sources, and such information has not been independently verified. No representation, warranty, or undertaking, expressed or implied, is given to the accuracy or completeness of such information by any person. While such resources are believed to be reliable, Evoke does not assume any responsibility for the accuracy or completeness of such information. Evoke does not undertake any obligation to update the information contained herein as of any future date. The content is intended for a general audience and does not constitute a recommendation to buy or sell securities or adopt any investment strategy. Any examples or scenarios discussed are illustrative only, involve risks and uncertainties, and do not guarantee future results. Non-traditional assets carry significant risks and may not be suitable for all investors. Decisions should be based on individual objectives, risk tolerance, and circumstances. Statements herein are general and may not reflect an individual's or entity's specific circumstances or applicable laws, which vary by jurisdiction. Further, speakers' views are personal and may differ from Evoke and MAI recommendations and are not specific investment advice, and do not consider client objectives, risk tolerance, and diversification. Guests may have current or past relationships with Evoke and MAI, its affiliates, or the host, including as clients, service providers, or business partners. Participation does not constitute an endorsement or testimonial. No compensation has been paid or received for guest participation unless disclosed. MAI and its affiliates may have business relationships with entities mentioned in this podcast, which could create potential conflicts of interest. These relationships may include advisory services, investment management, or other arrangements. MAI seeks to manage such conflicts consistent with its fiduciary obligations and policies.